Hey everyone, this is Brandon Rush. Thank you for joining us for another episode of The Agent Investor. The goal of The Agent Investor is to assist our audience in making informed decisions through these conversations I have with professionals who are affiliated in the multifamily commercial space. So today we have a good friend of mine, John Krause of StarVox Capital coming through. How are you, John?
Doing well, man. It's a beautiful day.
Yeah, absolutely, absolutely. So John is a good buddy. John through many functions over the years, and I finally got a chance to connect with him. I've done a number of his golf tournaments. He has a big story, good guy. So I'm gonna let you jump in, John, and tell us about yourself, how you're affiliated with commercial real estate, multifamily, all that stuff. Just tell us it all.
Hey, man. So thanks, Brandon, for inviting me to do this with you, I should say, not for you, with you, and giving me the opportunity to help people out with what we do, in terms of commercial real estate. So long story short, StarVox Capital, it's on the shirt. It started back in, I'd say 2019. 2019 is when I fell in love with working with investors. We started with our bread and butter, 1 to 4 units, fix and flip, DSCR loans, and then we kind of moved into the 5+ units through time. And that's where we've been ever since, getting into the commercial space with bigger properties and projects. But, we broker all of our loans. We've been doing it, like I said, since 2019, and we can do it just about anywhere in the country. So it's pretty fun.
Easy. Very nice. All right, we're going to dive right into it. So first question I have for you here, what are the most common types of commercial loans available in multifamily investors? How do they differ in terms of terms, interest rates, and requirements in general on these loans?
Yeah, I mean, for multifamily, if you're getting into, you can do 2 to 4 or 5+ units. I mean, it's all run off the debt service coverage ratio, the DSCR. Nowadays, if you're paying attention to anything, you see it all over social media. There's guys and gals that are doing these lives that are talking about what DSCR is and what that actually means. And just a real quick, if you haven't heard that, what that means is it's the debt service of the property. So what that is, it's the income of the property. So you're not using your W-2s, your tax returns typically to qualify. It's the income of the property that helps you qualify for the loan. So that's essentially the commercial side of the world. That's what I kind of fell in love with, working with investors that are really looking at the numbers. It's not emotional. It's the numbers and what they can get done with that property and what it's going to do for them in their portfolio. And it's a blast. But there are different variations. There's different types of lenders that we work with. There's your private money all the way up through your Fannie Freddie. So it depends on really what you're looking at. So if you're looking at maybe a 1 to 4, it's pretty simple, straightforward. DSCR loan, 30-year fixed all day long, every day. Everyone likes the 30-year fixed. As you step into the 5+ in apartment buildings, the financing does change a little bit. You still can get yourself a 30-year fix, but now you're looking more of a bank type loan a lot of times. Not a lot of times, but oftentimes I should say, where you're still going to qualify the same way, but they're going to have different types of terms, more bank type terms, like 5 years, 7 years, 10 years fixed, that kind of thing.
Got it. So just larger assets which is pretty typical for larger assets. They tend not to be on 30-year or even 20-year fixed loans, which would be incredible for a large stuff. But they typically be on short.
It's funny you say that. I'm working with a gentleman now on a 16 unit here in Connecticut, and it's a $2.3 million loan. The net operating income looks good. Everything looks good. But he's the type of guy that wants more of your safety. He wants the safety of that 30-year fixed. It's available. It's there. Your rates are probably going to be in the 7s, right? Which, isn't terrible, or you could go with a bank loan, 5, 7, 10-year. Maybe I can get him a 15-year fixed. Now the rates are in the 6s and possibly in the high 5s. So it really comes down to what your strategy is and how the financing is going to fit into that strategy.
Absolutely. Got it. And just to kind of go back to DSCR, for those who are not familiar with DSCR, as John mentioned, it's really, correct me if I'm wrong, John, it's really just a ratio of the income to the debt. And generally it's a percentage. So a lot of times that I know of, it's like 1.2, 1.25, which would be basically the income divided by the debt. And if it comes to 1.2, 1.25, generally kind of fulfills a lot of lenders for what their requirements are, from my understanding.
You nailed it. You
Got
know
it.
You've been doing it.
Yeah.
You are.
I try to keep telling clients. Keep trying to tell clients like this is the DSCR, it doesn't work, and they're just like, oh no. I'm just like, all right, guys. So anyway, let's keep it moving. So moving to the next question. If someone is looking to take out their first commercial loan, how should they prepare? What should they have in place before they come in and say they're ready?
Well, I mean, the things that are evaluated in any of these loans is going to be your credit score. So making sure your credit score is as good as it possibly can. Some of the thresholds can be 660, 680, but preferred terms are always going to fall in when you get the higher credit scores. Again, Is that in your control? Short term, probably not, but long term, if you're thinking that you need to improve your credit score, something you should really pay attention to. The other thing that I would say is your liquidity, your liquidity situation, whether or not you're liquid as an individual, or, and this kind of goes back to the credit score scenario, you can also partner with people that have more liquidity. You can bring a capital partner in. You can bring in somebody in that might have a bit better credit score to maybe help qualify. So those are the things on the personal level. Outside of that, I mean, you've got to have an LLC. You're going to want to put this in an LLC. I'm not an attorney, so I can't tell you the legal aspects of it, but most, if not all, lenders are going to require it, especially as you get into the larger stuff.
Got it. And when you talk about bringing on partners, I know there's, not to get too deep into the weeds, but, there are things like guarantors, who's responsible for the loans, like things like that. So I'd imagine that, could you talk a little bit about, not the details, but just a high level, if you were to bring in the partners, what would that look like with who's guaranteeing the loan, things along those lines, what percentages and things like that?
Yeah, I mean, it's the typical number. I mean, every lender is going to be maybe a little bit
Sure.
different, but yeah, sometimes it's majority. I've got lenders that say if you're 51 and he's 49 or she's 49, they don't have to guarantee the loan. I've got other lenders that are like, well, if they're on the LLC, they've got to guarantee the loan. So it really depends on the situation. So knowing your situation up front is helpful, because then it helps lenders like us kind of figure out, all right, where can we take you based on your specific situation?
Got it. So what I'm hearing is it's a combination of, as you said, credit score, knowing your structure going in, who is going to be partners on this if you're going to have partners, knowing how much capital you have available. And I think those are kind of some of the big things that you mentioned, which sounds good. And also having an LLC. I believe you don't necessarily need to have the LLC established beforehand, but you do need to create one prior to closing to put the loan into.
You're
Got
right.
it.
Most of the time, there's enough time between start and finish that you can get one. Those aren't too bad.
Yeah, I know in Connecticut, you can have an LLC within a week in most cases, so it's not complicated. All right, no, cool. That's very good, very good. So let's move on. What are some of the key factors lenders look at when assessing a commercial multifamily for a loan? What can investors do to meet these criteria? So I guess, in other words, what qualifies a building for a loan? And I know it's relative to the situation, but from a high level, let's say a turnkey asset that someone's buying, what would qualify it for a loan?
Yeah, I mean, I guess it really goes back to what we were talking about before. I mean, it's the debt service. Depending on what avenue we want to take it, whether or not we're going for like a bank or credit union type loan, like the real, a larger commercial property, or if we're going with more a private money lender, it still falls on the debt service. That's really what it is. Aside from the other things we also mentioned, credit score, liquidity, and all that, it's, you want to find an asset. If you're getting a turnkey asset where the purchase price really dictates it or makes sense based on the debt service. I mean, like I said, this property that we're looking at, 2.3 million, does the income that's coming in right now justify the debt service? Is the ratio right? Or is it stabilized? If you're looking at a 20-unit property, but there's 5 people that are living there, because that's the portion that's leased, and the rest is like gutted and needs. So, it really comes, there's a lot of things to look at when it comes to that. But really, the bottom line, I've done so many loans in this world, it's the debt service. You could have an asset that you think is, it's going to be amazing. It's going to be amazing. Well, that's great. Maybe we have to go with a bridge loan right now instead, because it's not amazing today, right? So it just comes down to strategy and strategizing with how to get you in the right loan for where the asset is today, and then move you, if we have to move you into a more of a long-term note down the road, we can.
Got it. It sounds like preparation is key in terms of knowing the product type that you're going after way in advance, because then you can determine if DSCR is going to be most important. If you're going after distressed assets, knowing that whatever the future plan is attainable, things along those lines. So it really is, how important do you feel it is having conversations with individuals like you in advance? Is it better to kind of have the conversation up front, or really to find the asset, come to you with, what's the best case scenario?
I mean, you could go either way. Obviously, we get people at all different phases of the process.
Sure.
And I guess it depends on where your experience level lies. If you're somebody new, then you want to understand a little bit how financing works ahead of time. You want to understand, well, shoot, do I have the liquidity, or do I need to go find a capital partner? Where's my credit score today? Like, these are things that we can talk about up front. And then from there, it's like, all right, well, based on what you're telling me, you have the money, you have the credit score. Let's go find you the asset. Now I find Brandon Rush and say, hey, Brandon, we've got a guy that needs to find or wants to find a 8-unit property. He's got 25% down and let's get it moving. So yeah, it depends on where you are in your experience, in my opinion. But it's not necessary to come right up and say, hey, we need to chat today.
Got it. Yeah, understood. And I'm sure there's much more experienced clients that can come to you property under contract and say, John, this is what I have. And you can kind of get rolling because they already know what terms are going to roughly look like and just get moving. So,
yeah,
very good.
No, you're right. I mean, we, like I said, there's people that come to us, hey, I have a property in contract and I'm shopping my bank. Okay, great. Let's shop with the 800 lenders that we have with the press of a button, and let's see if we can compete. And that's okay too. But yeah, I mean, everyone's in a different spot in their journey on each property, it seems like.
Absolutely. I'm kind of going off script. We talked about a little bit about turnkey. So when it comes to maybe not so turnkey assets, maybe distressed assets that are at 60% vacancy, but there's huge upside, I'm assuming those would be more of a bridge loan type of opportunity. And for the audience, and correct me if I'm wrong, John, but bridge loans are basically just short-term loans that allow you that bridge the gap between when you acquire it and when it's performing, and then maybe at some point refinancing into a long-term loan. But what does that process typically look like when someone approaches you with a distressed asset? What are you looking for? Same things?
Yeah, I mean, similar things. They're still going to look at DSCR, like what's it look like today and what's the pro forma look like down the road when it's fixed. Because that's all going to tie into the valuation and how much it's going to be worth, like based on, appraised value, whether or not it's market or income approach. So yeah, they're going to look at that. Again, experience-wise, you're buying a 20-unit property that you've never bought one before, and you want to rehab a 20-unit property, but maybe you've only rehabbed a single family. So then experience comes in because they're total different animals. Doing a rehab on a single family versus a commercial property. There are a lot of factors that go into financing no matter what. And really comes into factor quite a bit.
Got it. And does it, I'd imagine experience, and maybe I'm wrong, but experience would come in more importantly if someone's trying to rehab a 20-unit distressed property versus buy turnkey when they have the cash in hand, and it's a bit more easier to accept on the lending side.
Yeah, and it's crazy. When I first got into this business, I remember there were some lenders, speaking of which, the 5+ unit, they wouldn't even let people even buy them. It's like, well, how do you expect somebody to get to that space? So I had limited lenders at that point in time. Now I've got way more, but still, I mean, things change in financing. But yeah, no, it's with experience goes a long way, especially on the rehab side. But you can always partner with somebody who has the experience. So there's ways to get around that, strategize in the right way, and we can get it done.
Absolutely. All right. Now, good stuff. We're going to keep moving here. So what are some of the common challenges or hurdles that multifamily investors face when underwriting a commercial loan? How do they navigate some of these challenges they run into?
Well, I think some of the challenges are going to be, again, stuff that we talked about is, all right, is this going to make, how much money is it going to make me? What's my net operating income going to be? But so with a bigger property, they really need to look at the expenses. And the expenses aren't just the mortgage payment and the taxes and insurance. There's a lot more expenses that go into running one of those properties. Most of the time, a lot of times you have a management fee, you have the sewer, water, you have all the utilities, or some of the utilities at least, snowplow. Like there are other fees that come into factor versus like your 1 to 4 unit where it's like, here's the mortgage payment, here's the rent. There you go. We're happy. That works. Nothing else comes into play because every time that, I shouldn't say every time with 1 to 4, but most times with 1 to 4, the person who's living there is taking care of all the utilities no matter what. In a situation like we keep using the 20 unit, that may not be the case. The person who you're buying it from may have been paying for all the utilities. And that we're looking at operating expenses like, wow, this is jammed up. This is expensive. The income is like really, really small. Well, you plan on charging for utility. So those are the things that can be challenges is if they don't, and that's why experience comes into play, is because they think, wow, I'm going to make $100,000 a year on this property. Well, no, you're not, because you didn't factor in all these other little things. So, I mean, somebody who's seasoned, this is like easy stuff. But
it's back of the hand,
But yeah, I think that could be the challenge. If they're new and they're getting into this, it's somebody to learn from is key. Somebody who can really underwrite an asset is key. That could say, hey, I buy these and I know how to look at this and this is the outcome and this is the money that we're going to make on this and this is what the 10 things that you need to look at. Learning from that, not just trying to do it and hope for the best is going to be crucial to success because, number one, you may not get the financing if the numbers don't work. But the thing is if it does work and we could jam it through, maybe you're not going to make as much money today as you thought you were, whether or not you kind of underwrote it the right way.
Yeah, absolutely. Yeah, obviously one of the biggest differences, obviously, is newer investors versus seasoned. The seasoned guys are screaming at me about expenses when they're not in the underwriting that on the properties that are listed, versus newer clients they're very quick to dismiss those expenses, and they're kind of quick to jump in and say, "Oh yeah, this is great." And I'm like, dude, the vacancy rate you have at 3%, that's not even close. Or there's nothing here for maintenance on the property. And they jump to the assumption that this is cash flow. I'm like, it's not even close once you factor in everything true. Even if you have property management, you have it at 3% on a 10 unit. Like, you're not going to find that, know. So
right, yeah, you have to have real numbers in there. Yeah, you got to have real numbers. Otherwise, it's not going to work. You're going to be very disappointed with things, or like I said, the financing just won't work if it's not. You're not using real numbers.
And our lenders typically throwing it back when they send a T12 to you guys and say, here's a T12, and then it's missing. Either the expenses are on the low end, like they have 3% property management. Our lenders typically pushing that back and saying, how does that look? Did they push it back and say, this is incorrect, we need actuals, or they just flat out say no? Or
well, I mean, they're going to look for actuals. If something's missing, they're going to be like, wait, you should have something. We're missing some expenses in here. And I've had that come back. I've had things push back with that. And that's what they'll do. If there's something blatantly missing, it's missing. If something's grossly misstated, they're going to know. This is what they do. So, But yeah, I mean, it's not, if the prior owner has kept good books, I mean, they are what they are typically. There's, and like if you were to see it, Brandon, you're like, wait a minute, this guy's, these aren't real. Like you would be like, no, give me the real ones, please.
Absolutely.
I mean that's
and I deal with a lot of older owners, so a lot of it they do it old school way, like they don't have it. They're like, either they don't have it, or they have very slim expenses, but they didn't tell you about. They have a guy Joe that works the property and he's maintaining everything, but he gets a discount. It gets complicated. It's like it gets funky, but there are certain assumptions that should be made, and I'd imagine there are certain numbers that for areas that lenders are expecting for a certain cost. So, all right, now cool. All right, so John, let's circle back outside of the underwritings and the inner workings of these commercial loans. Tell us a little bit more just about StarVox, your offerings, and what you guys are working on.
Yeah, so for StarVox Capital, as I said before, we started at 1 to 4 unit, investor-only stuff. I mean, like I said, our bread and butter was a fix and flip loan, 1 to 4 unit DSCR loans. Started getting into 5 units. Well, what we realized when we started to do larger things like portfolio loans, larger portfolios, and looking into mixed use and different type of assets, we realized like on the broker side in general, the lenders, although out there, are hard to come by and hard to really get people the information and the terms that they need in a real timely basis. So we stumbled upon a company called ComLoan, which now we've partnered with and provides us with about 800 banks, credit unions, Fannie, Freddie, HUD, USDA. I mean, I could keep talking about the different type of lending they have. But the greatest part about what we have with them is anything commercial we can do. And if, let's say you have a borrower that wants to buy that 20 unit or that hotel, we can literally do financing for just about anything. And that covers SBA type loans. You may have a business owner that says, hey, I want to buy my building that I'm renting from. Great, let's do it. So like there's a lot of different options that we have now that we didn't have since 2019. And we're getting people terms and better terms much, much faster. Literally, you give me the information that I need, which isn't asking, it's numbers, it's information. But then I hit the button, and then I've got 160 different options of financing for you. Like literally in minutes, here's your pre-approval. Based on all this information, let's get this thing going. And it's a game changer for us as a company because now it just offers so much more for our clients than we had before.
Absolutely. No, good stuff. I definitely look forward to a client your way and doing some deals in the future. All right, so we're getting out of the business and getting more into the personal aspects as we start to wind down this talk here. On a personal note, I know you're a cancer survivor. Please tell us a little about your story and about the Team John Foundation.
Yeah, so cancer survivor. Yep, that's something that happened to me. Started in 2014. I was battled acute myeloid leukemia. It came out of nowhere. It came out of the blue, very aggressive. If I wasn't lucky enough to have a doctor appointment that had a blood test, I wouldn't have even known, and I probably wouldn't be here sitting here talking today. So I battled that. I was lucky enough to have a stem cell transplant for my brother, my younger brother, and that was in 2014. And I was good. I was good for 5.5 years. 5.5 years went by. I was working with a bunch of different companies. I launched this company, and a lot of great things happened. Then it relapsed in 2020 and came back more aggressive than before. So it was one of those things like, okay, why is this happening? What is going on? Like, it was more of like one of those situations where I had to figure out, maybe the bigger reason, like find a bigger reason. And that's when my wife and I stumbled upon the thought that maybe we should create a 501c3, a charity, to help other people. Because when I went through it, I had a community. I had people step up and say, John, whatever you need, we got you. And I recognize, and we recognize that not everyone has that. So when we launched this charity, we're like, we want to help people. And not just cancer patients, anybody that falls on sudden crisis. Now we get to step up and help them out because we realize there's people that just don't have a community like we do. Not everyone does. Yep. And they need a little leg up when tough times happen. So Team John Foundation started then, and we do a lot of fundraising. We do events at the Hartford Club and at different restaurants, networking events, and we do our annual golf tournament, which you so graciously have been to the last few years. So thank you for that. Yeah. And yeah, we just raise a lot of money so we can help a lot of people. That's the goal.
Absolutely. Yeah. I thoroughly have to say I've had good times at your events, especially the golf tournament. So I appreciate you putting that together, you and the crew, and I look forward to attending future events for sure. So outside of the Team John Foundation and business, personally, what do you enjoy doing? What hobbies do you have?
Well, my wife and I were blessed with 4 children. Ages are right now 9, a 9-year-old daughter, a 12-year-old son, a 15-year-old son, and a 17-year-old daughter. So through all their growing up, I was the type of guy I wanted to coach. So I coached my son's baseball, lacrosse, hockey, and now I coach my son's football and my daughter's hockey. So in my other daughter's hockey, I coached for a long time, and her baseball. So my family's been my hobbies. Like, that's been my hobby, just being there for my kids and my wife and just coaching my kids in sports. When I have some free time, I get on the ice every Wednesday. I play hockey still. 49 years old, still rocking on the ice and trying to anyway. I golf a little bit. I hit that ball around a little bit as much.
Oh, you play good, man. You golf a little bit more than I do at a minimum.
I'd like to golf more, but you know what? Business and family first. That's how it goes.
Understood. Yeah. All right, so moving forward, so how can people find you? How can people get a hold of you?
The best way to get a hold of me is, just shoot me a text. Your cell phone is 203-464-2424. Pretty easy to remember. Mm-hmm. I'm sure you can put my email address, jkrause at StarVoxCapital.com.
I'll get you all linked up.
That's easy enough. I'm all over social too. So yeah, at the end of the day, we're here to help people on their journey wherever they are. Whether or not it's and I didn't mention this before, whether or not it's a real estate loan or a business loan. We can help business owners get financing. And something new that we started is we do merchant services now. So anybody that processes credit cards, our company can help them take care of that, which is super exciting for me because that has a charity component too with it, where basically our company takes a certain percentage of our profits and donates it to the charity of the business owner's choice. So a lot of the things in alignment there with businesses and with lending and with charity. So it's kind of fun.
Absolutely. No, very good. Before we take off, any final words for our audience?
In the real estate world, don't be afraid. Don't overanalyze. Get the knowledge, the basic knowledge you can. Work with advisors like Brandon and like people in the loan business that can give you the tools. There's so many people talk about this. It's easier to get a loan to buy an investment property as far as documentation and jumping through hoops than it kind of can be to get a home to live in. So don't think that it's the hardest thing to do. If you have some capital or people with capital, connect with them. Open up a conversation. And before you know it, you may have your own properties and start your own portfolio. So don't be afraid. Get off your seat and just take action.
Yeah, absolutely. No, okay. So on that note, we want to thank you so much, John, for joining us today for this another episode of Agent Investor. And to our audience, thank you all so much once again for joining us. We want to wish you all the best in your health and happiness. And until next time, we will catch you on the next video. Thank you, John.
Thank you.